let's be clear, Bitcoin is an international asset.
We are spending like drunken sailors.
Bitcoin is the only economic entity where the supply is unaffected by the demand.
If you want to preserve your wealth, you have to convert that currency into an asset that's scarce, desirable, portable, durable, and maintainable.
All right. Welcome back to Scarce Assets. Kane McGukin. I'm glad I'm pronouncing that correctly live on air. Kane's with Arcos Global Advisors. They're a traditional wealth management shop. They're helping families thrive across generations, managing their wealth and thinking about their financial plan. But Kane's also a Bitcoin expert. If you're someone who's tuning in who's not as familiar with Bitcoin, Kane has a lot of great insights to share. I think we've probably got connected, Kane, maybe 2 years ago. I forget exactly the origin of how we got in touch, but I know we've had conversations in private in the past, and I've always been really impressed with just how deep your knowledge is in traditional markets, the pulse in the economy, geopolitics as well, and then, of course, Bitcoin. So really excited to have you on the show. I appreciate you making some time.
Yeah, Jackson, thanks for having me on. I appreciate that. I'm not sure if I'm an expert in anything yet, but trying to get there. So I appreciate those words, and the last name's tough, so I understand that. I get it internally. People always get it wrong, so I just shorten it and go by Kane. It's easier, so no big deal there. But excited to be on today. Look forward to having this conversation. I think every year there's something big in Bitcoin that makes it more important for the current and the future. This year with the strategic reserve and the White House summit, we'll leave one word out, but the White House summit, that makes this space important as Bitcoin and then just the broadening ecosystem builds out for the future finance. So there's a lot of ways that we can go and talk about that. I'm sure we'll get into it, but on my end, on the wealth management side, just traditional business, we have clients who are interested in Bitcoin. I've been doing stuff a long time in the space, so I try to some of it might be deep, but put out a lot of resources to help for those clients, prospects, people that have interest in the traditional side, and then try to make connections with people like yourself on the Bitcoin side. Like you said, we met, it was 2 years ago. I think you're right. I'm surprised it's been that long, but it was through something I had written that I was talking to somebody that I knew that I think introduced you to me. And so here we are today.
Here we are. Thanks, Kane. Appreciate that. And so could you just share a bit about your background? I definitely want to get into what's going on in the White House in DC and also at the state level as well. I'm curious to get a lot of your thoughts there, because if you and I think back even 6 months ago, 12 months ago, it was a totally different political and regulatory environment for the asset class. And I think that uncertainty has ultimately kept a lot of investors in the traditional space from allocating. So definitely cover that. But I think just to level set and get more of your background, you said you've been in Bitcoin a while now. How did you get into it? What initially piqued your interest about this asset or technology? And then how do you kind of think about that as high level? How does that mesh with your background on the wealth side?
Yeah, so I'll step back a little bit from that side. So I started, it was early 2000s in computer science, finished in finance, wanted to kind of get into the space, but not really on the, let's just say, traditional wealth management side. That's where I ended up, but always did portfolio management, investment analysis, kind of within inside a big firm. And so a number of years doing that, then worked a little bit on the institutional equity sales side, then left for a little bit, and then came back to the independent side, which is, you're just traditional wealth management, RIA, you're serving high net worth, ultra net worth individuals. As time moved on and algorithms sort of invaded and passive indexing became a bigger and bigger thing, the portfolio management side is frankly less important. It's not less important, but it becomes less important because clients have different needs that sometimes don't really matter if they own Google or Amazon or Apple. It's just real, like, how do I make this cash flow, this balance sheet, and those types of things work? So I took a lot of the early days, which was cash flow, balance sheet, and kind of how you would analyze a company, and then I applied it to people. So that's kind of a process we use. But once you sort of do that portfolio construction, that risk analysis side, and you start to understand how the different piece of portfolios works together, it's sort of hard to get away from. So, years went by, and then Bitcoin came along, just like everybody else. I kind of ignored it the first few times. I was looking back painfully last week at some old emails and found some from 2013, 14, where I'm sending it saying, you need to buy this thing, you need to look at this thing. So, it's kind of a painful memory of what could have, should have, would have been. So it was through those couple of years from 2015 to 17 that I really started to buckle down and look at Bitcoin and analyze it and, trade or whatever, like everybody else. Again, being on the portfolio side, my background is technical analysis. I know for a lot of people that's a voodoo type thing, but it really gives you a path both up and down to kind of better understand how markets and intermarket relationships work. So in traditional markets, the technical analysis side is for the most part broken. I mean, there's still things that work and there's still signals and trends and whatnot that matter, but just the human psychology no longer shows up appropriately. And we can talk about it later, but that's a lot of the massaging through printing money, and you got plunge protection teams that come in and step in front of price, and so they don't let it fall naturally. That didn't exist in Bitcoin and crypto. That's changed a little bit here in the last couple of years, but it was just natural human psychology playing out. So when I saw that, I was like, wow, this is what all the textbooks from the 30s and 50s and all the tape reading and stuff, this is what it's about, but it's real time. So that really kind of drew me in, and I'll pause there. Maybe you have some questions on some of that. Or we can kind of
so you came in more so from an interest in Bitcoin was a free market, and the broader space was accurately displaying market sentiment, buyers and sellers. There wasn't this elephant in the room or gorilla in the market, the Federal Reserve that was stepping in to bail out these markets. It truly was the Wild West back in 2017, 2018. And it was largely driven by retail. And so that, from a trader perspective, got you interested. And then taking it the next step further, how did you go from that point, let's call it 2017 or so, over the past several years to where you are today in terms of how has your understanding of Bitcoin and interest in it evolved in that time?
Yeah, I think, and I'll step back and add one thing. A lot of what's happening right now was my base case coming out of 2008. Because in 2007 or 8, when the buck broke and mutual funds blew up, and it was like the financial system was 15 minutes from truly collapsing, that was my birthday. And had a hedge fund client called before 7 a.m. was like, liquidate everything, get out. And it was one of the biggest hedge funds in the world they worked at. And he was like, it's all coming down. And I was like, sort of like, what is this? At the time, I'm in my 20s. So that set off, Wells Fargo collapsed, or not Wells Fargo, Wachovia. Wachovia collapsed. You had the mortgage insurers collapse, AIG, Bear Stearns. I started at Bear Stearns, left a year later, it collapsed. So I started reading through all the government emails and all the documents, the Dick Fold trials, and just like, what's going on here? And that sent me down the credit default swap rabbit hole. And basically, when you looked at the balance sheets, you're like, okay, well, I know why JP Morgan got Bear Stearns. My assessment was you got two firms with the largest trading pairs to each other for these toxic assets that can blow up the financial system. But if you stick them together, you have one firm and you have no trade. You can't be the buyer and the seller of the same side of the trade, or opposite sides of the trade under the same roof. So in my opinion, there was some of that. Obviously, that's not official. Nobody ever said that, but it makes sense from a financial system perspective. So my base case coming out of that was, from early on, we had hedge funds and then mutual funds, and there was always a bigger fish, a retail, come in with a lot of money to gobble up these assets, create a bubble, and a bigger fish gobble that up. And that was the support, and the Fed sort of backed it all up. But I was like, well, there's nobody bigger than a central bank. There's just not. So now central banks are the largest hedge funds in the world, but they don't have hedge fund managers. So the next crisis post 2008 will have to be a government crisis, because you'll have lost faith in money and all the stuff that we're seeing now. And you've seen along the way smaller government central banks run into trouble, currencies collapse. But now we're getting into the big boys, right? And this go around, what did we get, to run the Fed? We got a hedge fund manager. So, or treasuries. So, that was a big thing for me. I was sort of like a Bitcoiner back then in 2008. It was like, wow, next Wednesday, we're going to be at 1 million. Kind of like next Wednesday, all this is going to collapse down. So it didn't. And it took whatever from 2010 to 2020, so another decade for it really to resurface. And it started resurfacing in 2017, 18. Gold spiked and interest rates. That relationship wasn't correct as normal. So I went back, did some research on some old books that I read, and I was like, well, okay, gold's got to be running again. And that was slow to play out. But over the next 3 or 4 years, we kind of saw that. Today we're seeing gold run like crazy. But anyways, it took it so long to happen. I got frustrated in the middle and was like, well, all of this stuff that we're sort of frustrated with, the printing of the money, nobody really cares. And if we're not really, using money in a sound way, and it doesn't really matter, and it's all just funny money, then kind of what are we doing? And so I left the industry for a little bit and came back on the RA independent channel, and kind of use all that to sort of help people understand how flows of money work through their personal finances. So that was a long way of kind of trying to tie all those together, and why, I think what's important about today, because I think that having an understanding of all that helps the individual kind of not pay so much attention to the headlines, but pay attention to the things within their 4 walls of their house and the budgets and all that. So it was a little bit of a tangent there, but thought there was some background that might help you.
Yeah, that was great. The idea that central banks are operating as hedge funds really resonates, just in terms of post GFC, this, I guess, over 15 years now. Just seems that there's been poor risk management. You mentioned that they're operating as hedge funds, but there's no one really managing risk. And so that's a big concern, because as you mentioned, there are no entities that are bigger than the central bank. So I'm curious, we've been seeing a lot of market volatility the past couple of months here. Just yesterday, we're recording on Thursday, April 3rd. So yesterday is when Trump's tariffs were announced. Markets continue to be shaken up post that announcement. And we have the 10-year creeping down. Inflation's, I guess, somewhat under control if you look at the official metrics. What are your thoughts on where we are in terms of the economy and markets at the moment? Do you think that the headlines are a little bit overblown in terms, I think we said right before we hit record, every time I open the Wall Street Journal, it seems like the world is ending. So what are your thoughts just in terms of sentiment, and what's actually worth paying attention to in the markets right now?
So I think first off, in terms of what's paying attention to, it's, what are the things you can control within your household, within your budget? Those are the most important things, and get those out of the way first. If you have cash flow needs for certain things, make sure it's set aside, not invested. That's probably the biggest change in my career. When I came into the markets, you had savings and you had investments. Savings, you didn't put in investments, but you kind of had yields back then. It was a little bit, not much. But then everything went into investments, right? Not a bad thing, but it creates financial strain when your investments drop 20, 30%, like what we saw in 2022, 2023, or 50% or more. So in terms of the backdrop of the economy, of the markets, of the news narratives, I think as much as you can, turn all that off. That was one of the earlier things I did in 2013 or 14. I just stopped watching the news altogether. Now I pay attention to news headlines, Twitter feeds, probably too much. Once you sort of see the patterns, you can kind of know which ones to, or have a better feel of which ones to look at, which ones to follow up on. I get more news reading classical text than I do from modern day, because all the past events are just the same event again. You replace the names, replace the dates, replace the headlines. So that's helpful. And then in terms of the economy, I think we had the Great Depression, early 1900s, the Great Depression. We had Bretton Woods, World War II ending, the monetary system being reset. We had 1971 with, it was really the second go around, but coming off gold standard, getting petrodollars. And those were three separate events. And so there were three separate strategic plans that were put towards that event to stave that situation off. And now we are facing all three of those things at one time. Technically four. So the geopolitical infighting that was kind of like 1900 to 1922 and then carried into the 40s. So you had those four things, and we're facing them all at once. So you got big picture US, China, Russia. It's really been US and China. And Russia kind of stepped in later. And then you've got the problem with the dollar, which effectively, I think we can get into this a little bit, but Bitcoin's role is that next liquidity feature. And a lot of what's going on with Bitcoin is much like what we saw with Bretton Woods. So the dollar became the dominant system, and you had the handful of currencies around it, which led to 180 currencies, not all of them very important. Well, if you have Bitcoin at the center and you have these stable coins, which is much fewer than 180, that become a dominance and importance for our digital markets and digital rails, and that's just where our life takes place, but we don't have a money in that system. So you're really creating that same Bretton Woods-like system up, but in our digital life. And then with the 1971 just coming off gold standard, everything's off gold standard. So you have the fundamental economic problems of the 40s. Biden's plan was very much like, I think it was Roosevelt's plan, almost exactly alike. And then now we're trying to figure out the inflation component, which we haven't had to figure out since the 70s. So we saw markets kind of early 2020s, 2018 act like the 40s. And now we're seeing them act like the 60s and 70s. So, big picture, having to live four major events under one roof is a little bit different than getting to live them at 40.
Sounds scary.
Well, I think it does sound negative, but the opportunity is, think about having the opportunity to be one of the builders and one of the people implementing Bretton Woods, one of the builders and planners of figuring out how do we rebuild the world after World War I and World War II, or think about being one of the builders of the derivatives market in the 80s and commercial, like what Strike and Lightning and those networks and components of those networks are doing are nothing different than the 1980s commercial banking build out. It's, instead of having big banks with a sign on the front on different geographical countries at different parts of the world sending money back and forth. They just put a computer node. And so a lot of those, I think the opportunity is being able to be part of that rebuild of the infrastructure going forward. So maybe that's a little brighter.
Yeah. Well, this clip resurfaced in the past day or two of Treasury Secretary Scott Bessent. I believe it was a clip from prior to Trump's winning of the election. And he said, in the next few years, we're going to have some kind of grand economic reordering, something equivalent to a new Bretton Woods. There's a very good chance that happens in the next 4 years, and I'd like to be a part of it. Yeah. And so that's almost exactly what you said. And it speaks directly to being a part of building that new frontier, right? Or being at the table for the reset of the monetary order. So what are your thoughts? You kind of laid out the four bigger forces that are currently at play. What do you think that this next iteration looks like? Does that tie into the Bitcoin stablecoin discussion you just mentioned? Or are there other things maybe we should talk about first before getting there? What are your general thoughts about these next 4 years and the global economic reshuffling?
So, two things. One, I didn't really answer. I realized. So Greenspan in 2000 kind of set off this notion that, and this is where kind of prices really start to get massaged and animal spirits got wiped out, but that they could go in and sort of manipulate markets and data to do whatever the narrative that was being pitched was. And that's how the markets have worked in our lifetime. But prior to 2000, there was inflationary markets, which means stocks go up, then bonds and commodities, and stocks and bonds can go up and down together. In Greenspan's time, because they created bubbles intentionally, that created this risk on, risk off. Stocks go up, bonds go down, bonds go up, stocks go down. That is actually deflationary in nature, the behavior of that. But stock markets before that had been inflationary in nature, which meant they could go up together, they could go down together. And so that all changed in like 2017, 18, with that gold chart that I mentioned. And so we've been back into an inflationary environment. So yields are above 4, stocks are still running. Well, I mean, general theory is that stocks can't go up if yields are rising, right? And 4 to 4.5 is kind of that breaking point. And stocks went down, bonds went down. We've had no hedge in bond land. If you're a Bitcoiner, that was your best hedge, right? Because that was a long vol asset. So we had volatility, interest rates declining for 40 years. So you wanted to be short vol. So when you trade options, that's one of the biggest things is short vol strategies. Now, because we've gone back to an inflationary, makeup, you want to be long vol. And that's one of the important parts of Bitcoin. So that ties in there. Trump's policy appears to be, and I don't know, I don't follow it in depth, but completely opposite of that. Hey, we just can't live on credit forever. We got to tighten our belt. And it's going back to some foundational principles. We get reckless spending under control. Now, my guess is he's probably going to create as much currency as everybody before him, because since Obama, I forgot the numbers, but Obama did, I don't remember, 8 trillion, Trump did 16, Biden did more than that in the first 4. And so, everybody's like, well, how did we get here in the US and the economic system get to the shape? It's not Trump or Biden or Republican or Democrat. It's 50 years of both sides of the aisle making fiscal and policy mistakes. And so I think where Trump comes in is he plays his own game, whether it's good or bad. And I think we know what doesn't work. It's the stuff that we did for the last 30 years, and we got to try something different. So maybe that works. And then lastly, Bessent saying what he said about stablecoins. I wrote an article about that it was 2022 or 2023 in Bitcoin Magazine. And that summer I read the Paul Volcker book. I forgot the name of it, but it's his main book. And it was very clear the problem that we face today is the same problem he faced in the 70s. And so in 59, I think it was sometime in the 60s, they created SDRs, which are special drawing rights, which are effectively fake money that only central banks can use. And so in COVID, they ramped SDRs through the roof. Nobody, so you ramped fiat currencies at every country, you ramped them through the roof, printing them, and nobody talked about the SDRs, but the fake currency, which was supposed to be a digital currency between the central banks, they ramped that thing through the roof worse than fiat currency. So that's, to me, is like 2 times the amount of liquidity going into the system. So that they had the G7, which was, or G5, and then it became G7. So they were trying to figure out, how do we have these meetings between the countries to, hey, you can let your currency fall, we'll let ours run, but we got to switch these agreements. But it took 3 weeks to fly from one country to another and get back and inform everybody. So the problem was, they didn't have the technology, they didn't have a true digital currency, they didn't have Zoom, they didn't have cell phones, and had to do everything basically on Notepad. Well, today we sit in the same place, but we have cell phone, Zoom, and we have programmable money, and we have Bitcoin, and we have stablecoins. So all those things allow us to solve liquidity problems, which are just flow problems. And so that's sort of what was sent. He's like, hey, this is an opportunity. I've done cool things. I've worked for George Soros. I've been involved in some of the biggest parts of the market in history. I have a chance to go make a difference. And so I think it's smart to do that. I think that's a big opportunity.
How do you weigh so I haven't thought too much about that parallel you just draw between the SDRs and stablecoins. So one thing I wanted to talk about, and I want to get your opinion on, you know more about it than I do, is, so in this context of the reshuffling, over the past decade or so, there's been adversarial nations looking to accumulate more gold and start to reduce their intake of U.S. treasuries.
Yep.
And so Tether last year was the 7th largest buyer of U.S. treasuries.
Yep.
And I want to get your thoughts on, how do you think about it? How do you think people within the cabinet are thinking about the flow issue that you just described versus the dollar dominance geopolitical issue of de-dollarization versus re-dollarization with stablecoins? Is it the same side of one coin, or are these two different issues that need to be addressed?
So I'll take you back. So when I really started diving in on Bitcoin, that one of my first thing was, you can't centralize it. You can't, it's resistant to governments, all that stuff. One thing that Wall Street is very good at is cornering an asset, commandeering it, and making it do what they want it to do. And I think if you look at the 4-year cycle of Bitcoin, this year is very different. What's different about Bitcoin's price and its 4-year cycle is that there's now futures, there's options, there's ETFs and options on ETFs, which gives a lot of Wall Street tools ways to impact price. And so I think why that's important is because early on I was like, well, the one downside to this asset is, yes, it's trust in a trustless system. It's code, it's enforceable law, it can't be changed. But when you start putting derivatives on a spot asset, you can change the behavior of the asset. And that's very much what we're seeing. I mean, you have a large chunk of Bitcoin that's lost. I think it was River or somebody put out something the other day that was like, I don't know, 1.5 million. I'd always seen like 4 million coins. But anyways, big chunk that's lost. MicroStrategy now owns a ton of Bitcoin, and the ETFs own a ton of Bitcoin. So you have ways for people to say, hey, we just issued this new financial regulation. It applies to you. Either, do what we say, or we take your company, your assets, whatever. That's the negative side. The positive side is you turn MicroStrategy into a bank and you start lending on Bitcoin in the same ways that you have lent money for hundreds of thousands of years. But it kind of blows up the, sound money aspect. But that's what happens to money. You start sound and you eventually become unsound. It breaks, something else comes in, starts sound, unsound. It's just a cycle. And so the stablecoin piece, so all that's kind of the way. And I think that was telegraphed very early on. We were talking before. I think it was 2017, might have been 2020. I don't really remember. I posted it when I saw it, but S&P, so Moody's, Fitch, and S&P they rate bonds and all these other financial instruments. And that was the big thing that was the problem in 2008. They were getting paid for ratings. It was pay to play. And so they were rating all this toxic junk A because, or AAA, A, AA, because firms were paying them. Well, they rated compound. And I was like, well, why on earth is S&P rating an algorithmic stable? Unless one of the big problems in 2008 was money markets. And they broke, and the linkages and the times and delays. And so if you have these programmable monies that are being rated by traditional financial institutions when it's a no-no for them to even be thinking about it, that's a fundamental sign. And so we fast forward to today, and you've got, Treasury is saying, hey, we want to be involved in stablecoin. And we got a strategic reserve, and we want to bring this technology to the financial system. So I think the signs are there, and I think, like Basant said about another Bretton Woods, I don't know why, and it's kind of baffling to me, that the second and third world countries didn't do this 3 or 4 years ago, like when El Salvador came out, because that Bitcoin, and I know it's not popular, but crypto rails in a way, it's just flow, it's just moving money. But Bitcoin was a way to them to opt out of the dollar system, a way for them to set up their own financial freedom, and they didn't really do it. So now we're still in a financial mess, and Basant saying, hey, this probably makes sense. Probably the biggest shift for me in the last 2 years is that while dollars do have the negative stigma of being cash is trash, because it is, there are periods where it's useful, but most importantly, it kind of is the best layer 2 network known to man, because it doesn't matter what country you go in, you show somebody $1, they're going to accept it, because most people in those countries want that thing. So what I'm getting at is you can still use Bitcoin, the savings technology, but actually buy a Coke in China with $1 bill, and you just liquidate some Bitcoin right there, and do it, or swipe your credit card, which uses dollars, and pay that bill with some of the dollars that you took out of your Bitcoin at some point. So that probably is a little bit faster than, like Saylor has said for years. I couldn't repurpose all of his terminals inside of MicroStrategy, and if he told all his vendors and customers and everybody they have to pay in Bitcoin, it would be too expensive to overhaul, and it would be such a pain that that's a way that makes that work. So what I'm getting at is, if you got all these fiats, they're collapsing into dollars, the milkshake theory, but the dollar, the known exchange unit of it, is still useful, and the network of it is still useful. Then you take Bitcoin and a stablecoin set of currencies that are more useful than the 180 fiats, but you had, like, let's just say 10 or 13. And guess what? Those stablecoins, USDT, USDC, all those things solve the Treasury's problem. Who's going to buy these bonds?
Yeah.
And it actually, the 2020-2021 issue of yield farming, it solves that, because there's real yield underneath there versus just crazy who knows what.
At Onramp, we believe that Bitcoin is the most important asset of the 21st century. The hard part is securing it right. There are shortcomings with keeping your coins on an exchange, but also with setting up your own self-custody arrangement. Onramp solves for these concerns. Our multi-institution custody solution maximizes security and minimizes counterparty risk, ensuring that your Bitcoin remains securely in your possession, and provides built-in inheritance planning to ensure your family is protected as well. Onramp provides peace of mind for your Bitcoin journey, whether for your whole stack or for part of it as a complement to your existing self-custody setup. For more information, check us out at onrampbitcoin.com.
Yeah, that was incredibly insightful. And the thing I'm still trying to grapple with is now, so these BRIC nations, right? BRICS, they've been pushing for gold and settling yuan and other fiat currencies for hard assets and commodities. Does the stablecoin Bitcoin monetary reset that the US is pushing forward, does that just kind of leapfrog all the efforts that these BRICS nations have been working on over the past decade?
I mean, it would seem like it. I think it's smart from the U.S. standpoint. I think this administration versus the last one, I think to, go Elizabeth Warren on it and try to shut everything down and keep innovation from happening is a very traditional way of doing banking. I don't think that's smart. Zuckerberg told them that, one of the congressmen or senators, and when they dog and pony showed him around Washington in 2017, and the guy said, "Look, son, do you understand that this is a weapon that we use?" And he said, "Do you understand that technology is innovative or get bypassed?" And so, I think taking the stance where you're not going to use Bitcoin, stable coins, and this innovative technology to better money transit and potentially lifestyles is not a good move. So I think it is good, and I think it could lead to that. I mean, who knows? I think that's the hopes, because China is with their Belt and Roads initiative since 2010 or 12, maybe 15. They've bought up most of the critical resources around the globe, and so that puts them in a dominant position, whereas we've kind of offended a lot of people by aiding different things in different groups. When you're number one, the target's on your back, but when you're number three, it's kind of easy to backdoor. We did it to Britain in 1920s and 40s. So China's running our pre-19 or early 1900s playbook, and we either have to defend well or figure out a new one. And that seems to be Bitcoin, and I hope it works. I think there's a lot of use for it to work.
Yeah. What are your thoughts going back to the derivatives that you commented on 5-10 minutes ago? I'm curious to hear your thoughts just where we are this cycle. You mentioned that this cycle feels different in terms of the price, and you made a case for that's because there are all these derivatives and financial instruments that didn't exist in the previous cycle. So what are your thoughts in terms of derivative exposure on the price of Bitcoin? Do you think, would you be bold enough to say that there's some sort of manipulation of the price? Yeah, let's go there. I want to hear what you think.
Look, I ran the daily volatility of Bitcoin from 2010 to now, and I looked at the date that each one of those things, the futures, so that was 2017, the options, I think it was 2018, sometime around there, then the ETFs this past year, and the options on ETFs. And the date of launch of each of those, the volatility profile dropped going forward. So, I always try to explain it. An insurance company, they collect premium. And modern insurance companies, they create an index, a price that they're pretty comfortable with. Doesn't mean the price is not going to move, but they're pretty confident in how it acts. And so when you do that, you do option bands on either side of it to collect premiums off of what you're pretty confident that you know where it's going. Now, there's going to be times that you lose. AIG was an example. But you can collect a lot of premium off that. But what those volatility, what the options do, and what you kind of understand when you understand volatility is you sell the high and you buy the low. And that naturally suppresses price over time. That I've written, it's the same things going on. I don't know if you saw the past week or two, about the Fed potentially having to step in and back hedge funds because of the arb trade. So
I didn't catch that. Yeah. Can you cover it?
yeah, so arbitrage is effectively using derivatives, options, just financial engineering to, take advantage of market inefficiencies. They evaporate really quickly. But really what that does is it pushes price around. So it massages, suppresses price, because when you have paper products, so derivatives, before I get on that, let's just step into it right quick. If you had 1 Bitcoin or 10 Bitcoin and the market was 10 Bitcoin, so fixed supply, and you had a buyer that had 5 and whatever, another buyer comes to buy 6. So there's only 10. So that price has to adjust out to force the guy with 5 to sell. That is but if you have paper products and a buyer with 6 comes in, you can create an arb market with paper and create out of thin air enough to cover that 1. So if there's more demand coming in, you can create more paper on top to push it down. If there's a lack of demand and price comes down, you can create demand through derivatives that buy in at cheaper prices to inflate that demand. So I think we're seeing that. I think the volatility tells you that. I think that the GBTC trade was early signs of that. The roll 40% a year. It's just a covered call, and that sounds fun and can be lucrative until your asset drops by 20% or more, and then you're stuck with an asset. You got to wait for it to recover. So that's that side of it, and the volatility profile tells you that. And then you'll see there are a number of charts that show like the average of the 17 through 2025 or the previous bull cycles. And in this period, Bitcoin's basically flat from here to here, when in the other markets it was already running. Now, do I think that Bitcoin's price is done? No. I just don't think it goes as high as kind of the expectations, because when you look at the power law, the multiples decline every cycle. Again, it's just like that volatility. There was another half of the question. I forgot what you asked.
No, that was kind of the gist of it. But I wanted to get also a sentiment check in terms of where you think things go through the rest of the year. And one thing, maybe even before that, on the outlook side, just what's your framework for thinking about Bitcoin as an investable asset? If you put on the hat of someone who works in traditional finance and is still coming up the curve on what Bitcoin is and its merits, its fundamental properties, what do you think the most important things are to dig into or pay attention to?
Yeah, I think that's a good question. I think first and foremost, kind of like back earlier when I said find out what your priorities are and make sure you're hitting those first. So if you got expenses, don't put all your money in the market. Make sure you're covering that. I think, and I'm not a huge Warren Buffett fan, but understanding what you own is probably a pretty good thing. And it's don't get jaded. If you had come into Bitcoin, I was talking to a guy that was a pretty big guy, and he's like, well, I found Bitcoin at 2021 and I was waiting for it to come down to 25,000. As an institutional guy, that was a big number for most of them. And I bought it, and this is the greatest trade ever, and I'm going to start levering it and all this stuff. And I was like, look, the bull markets only last like a year. So just, be careful, right? Because I don't know if you've ever sat through anything at an 80% drawdown. It hurts. Now, could be less again with banks and derivatives. I would expect that it's less, but that's what it has been. So in a bull market, it's easy to own. You need to own Bitcoin both through a bull and a bear. Nobody's great enough to time the tops and bottoms and get them all right to truly figure out Do I want this thing in my portfolio? What percentage should that be? I think everybody's different. What I've found on the traditional side, it's a lot lower probably than it should be because the emotions just aren't there. The capacity to withstand those drawdowns aren't there. A traditional client is not used to seeing a 30, 40, 60% drawdown in a position. Not many stocks go to zero. Nothing really goes to zero that much. They happen, but they'll go to like $2 or $3 and just sit there and forever. And so I think on the traditional side, it's like, man, I see this thing at a 30% decline. I'm never going to make my money back. Like I just won't even get back even because that happens a lot. Now with Meta, Facebook, Amazon, Apple, the FANG and Mag 7, that's a little bit different story because those did recover and they did go, they had bloodbaths, but traditional companies just few and far between don't. So that's the hardest part with Bitcoin. The highs are high and the lows are low. And so I have a lot of conversations where I'm probably more, risk averse with the traditional wealth client just because I've seen a lot of them. And when CNBC's pumping it and Sailor's on every day and, to the moon, Bitcoin's at $1 million by next Thursday, they want most people want their whole portfolio in. But then if you do that, then by the, 3 months from now, when it's down 48%, they're ready to fire you. So you kind of have to, it's a hard thing to balance. I think for the modern portfolio, I touched on it, but if you're in a short vol environment for the last 40 years and we're transitioning to a long vol environment, I think that everybody should consider like what component Bitcoin plays, because I think like we got every few decades we get an update to the modern portfolio, and the 60/40 hasn't done that well this decade, and I think Bitcoin would help with that. I know Bitwise was one of the first ones to have these for traditional advisors, these models where you say, hey, take your normal equity ETF model, stick Bitcoin in it, and look at all the fancy statistics. And I think Bitcoin has a place in the modern portfolio to help the limitations on the bond and even to an extent the stock side.
Yeah, that makes sense. And one of the things as well that ties into that in terms of being long volatility, also you had mentioned earlier that it doesn't really matter who's in office. There's going to be more fiat currencies, more dollars that enter the system. Mm-hmm. And so what are your thoughts then in terms of this next bout of inflation? Because right now things seem to have cooled off. And it seems that more people are concerned about an economic slowdown than they are, a recession than they are inflation. And so how do you kind of think about, there's a lot of angles we could go in, but I'm trying to parse out dollar debasement's inevitable. Mm-hmm. There's going to be more and more liquidity in the system because it's credit-based. You need more dollars.
Yep.
That drives up the price of Bitcoin, drives up the price of other asset classes. But then also to the other side, you said that Bitcoin's returns are diminished compared to previous cycles. There's these derivatives that are compressing volatility. So it's a two-part question. The first piece would just be general thoughts on this next bout of money printing or expansion of the money supply. What's kind of the catalyst for that? And do you have any sort of timeline there? And then the second piece would be, why so bearish on Bitcoin if there is going to be more, expansion of the dollar supply?
Yeah, not bearish on Bitcoin, but I do try to. I feel guilty if I drive the car off a cliff for someone else. So I try to tamper my inner bullishness of Bitcoin so that somebody has a hopefully a less painful ride. I won't ever have anybody YOLOing in. I think that's safe, but they can do that. So I think let me go back. I kind of lost track there. In terms of inflation, I think it was Peter Thiel in Bitcoin 2021. It might have been 2022. He gave that presentation, and I think he's the most spot on. At the time, it was heavy narrative. Bitcoin's an inflation hedge. It is when you look at it long windows. But when inflation ramped its hottest, Bitcoin didn't do that well, because people were having to make real household choices. I've got to pay more for food. My income's not going up. It's flat to down at best. I have to sell something to buy these things that I need. And it's like I told a younger guy, I was like, look, I like Bitcoin, but you can't eat your Bitcoin. You can't sleep in your Bitcoin, and you can't wear your. And so when you get into an adult lifestyle where you've got kids and you've got vacations and you've got a lot of different things, if you didn't buy early and you didn't have a ton, you have to look at your financial resources and say, which ones can I sell? And most people, when you get in a bear market, they lose faith. And so they sell that thing and then, kind of have frustration with that 6 months later when it rises. So I think he astutely and correctly pointed out that it's the warning of inflation. And ever since then, when you've seen Bitcoin rally, then you saw inflation come in. And so, gold faces that same thing from time to time. Like, it's an inflation hedge, but it went dead and dormant from 1980 to 2007. Like, you'd have wished that you actually lost money. That inflation hedges don't mean that every time there's inflation, it has to go up. But I think Bitcoin has been a good warning of inflation. So that's the inflation component. And then what was the second part?
Yeah, the second part. So the first part was about the inflation, and then the second part was more so just about why so bearish. But you kind of answered that question as well. So I guess your thoughts then, to summarize that, you don't necessarily think
liquidity. So with the liquidity and whatnot, I think what really has me most bullish about Bitcoin is, there are only really a couple of store value assets prior to Bitcoin: land, artifacts, tools, art. Those, not that big a deal. But land and gold. So gold's the only money that's ever lasted throughout mankind. So I think gold will always be here because our entire basis around monetary systems is based on gold. And that's where Bitcoin gets that digital. And I think they will work side by side. But from a liquidity standpoint, Bitcoin is the only store value asset that you can instantaneously settle and pay for something. Not, I'm going to pay with Bitcoin, but if I just swipe my credit card for $100 and I have a Bitcoin stack, I can instantly settle that, it be in my account, and send that to pay off my credit card, all within, let's just take the longest confirmation, an hour. So to sell land, it takes 6 months. In a hot market, it could be a week, but it takes 6 months. To sell a bar of gold, if you got it in storage or whatever, it could take a couple of days. Right? Even if it's at your house, you got to go to a pawn shop and then you got to agree on a haircut. Whereas Bitcoin is just like, boom, done. I can ACH those dollars from whatever exchange or wallet to my bank and pay the credit card. So
yeah,
I think
that was over the summer too, right? Where the everyone kind of rushed to the door with the yen carry trade. I believe that was in July or August, and Bitcoin crashed maybe 10% or so. It might have been 10,000. It might have been greater than 10% over the course of a weekend, because that was the only market that people could tap into.
Yeah, so great point. When people are forced, they sell what they can, not what they want to. And so, unfortunately, the ARB trade that we mentioned and the derivatives kind of pushing around spot is part of, part of the admission to be considered a global financial asset.
Is there a flip side to this in terms of the the power law, you mentioned diminishing returns, derivatives, pushing down volatility. Is there a flip side where the US government clearly they've made a clear stance that they want to be the leaders in Bitcoin. They delineated between Bitcoin and crypto with the strategic reserve versus the stockpile, exploration of, budget neutral ways to accumulate more Bitcoin. So isn't there another side to the coin here where Bitcoin is kind of in this consolidation period, but the table's kind of set in terms of sovereign nations stepping in and accumulating a finite asset? I mean, that seems to be like the other side of, volatility is diminished over time. The cycles are still relevant, and perhaps the cycle's more muted compared to the others. The other one would be, well, now we have these massive pools of capital that may potentially be accumulating Bitcoin, whereas this market, certainly 10 years ago and even 5 years ago, was still largely a retail market. Even today, 70% of the Bitcoin is held by individuals.
Yeah, I don't, and again, the price of admission to become a global asset, you can't do it on $500 trades. You have to have real serious capital come in. And institutions, just by nature of how they operate, aren't willing to cold store. I mean, institutions are cold storing, but you give them a asset they're comfortable with, one that gets through their bylaws, one that they don't have to go through legal and compliance to fight to get it in, which is why a lot of them bought MicroStrategy and other things like that. They're effectively buying Bitcoin, right? Particularly with ETFs, because that money's going to buy Bitcoin. Now you buy MicroStrategy and it just goes somewhere else in the market to a seller, right? Yeah, so that brings big capital in, and at this phase, it kind of fits with power laws for a system to continue to grow exponentially in that regard, 10x, 10x up and 10x time. It has to eat more capital. It takes more resources. Otherwise, it dies. And so, if you look at cell phone, look at Verizon and AT&T today. T-Mobile's there, but they're all three basically fighting over the same customer. Android and iPhone, they're fighting over the same 4 billion people, right? We are creating more people. We're not creating more people that are of age to use those things. So they're like, hey, if you come join my side, I'll give you Netflix and Hulu. And then the other side is, well, if you come join my side, I'll give you Netflix, Hulu, and ESPN. And then if you come join my side, I'll throw in Comcast. And so they're, because when you go on these, whether you look at an S curve or a power law, it starts to bend, it starts to flatten out. That's the price of admission for maturity and adoption. Like, it just takes a different level thing. And some of what I said about massaging is natural. As adoption happens and that price flattens out, that's because the volatility flattens out. And in financial systems, when the volatility flattens out, you get more products, which is why I say, okay, you can turn MicroStrategy into a bank because you can create revenues and things off the top of it. So I think it sounds negative, but in a positive light, the maturation of Bitcoin and the lowering of volatility and all those things just mean it's further proving it's doing what a Bitcoiner has always said it would do. Eat the world, eat everything in it. I personally think that just like in 2000, you had nerdy guys working on HTML and everyone's like, why would you ever want to do that? You're a loser, get out of your mom's basement. But then in 2008, they were rock stars because they were setting up all the infrastructure integrations with AWS. And then that became API integrations, and we're getting those API-like integrations in our money. So people between 2009, or really you say like 2015 and 2021, that really understood the infrastructure of Bitcoin and what it could do. I think in another decade, every company will have some kind of Bitcoin wallet or some kind of crypto wallet to hook in, and just like every site eventually got or every company eventually got a website. So I think all that's positive.
Absolutely. Yeah, no, and that's just starting to come to fruition, right? Because for cycles, certainly in 2017, even 2021, there was all this chatter about, the institutions are coming. I think 2021 more so. Banks were actually starting to prepare to enter the space, and then FTX happened and everything blew up in 2022. So set back some plans for years, among other things as well. But I agree with you. I mean, we talk about it a lot, right? We're early to Bitcoin. I still believe that to be true for many different reasons. But the implications of that, of course, are that things haven't been fully figured out yet, right?
Yeah.
So you play that out 10 years from now, maybe you have banks will still exist 10 years from now, and perhaps people have banking relationships where they have still a dollar account, checking account, but then they have a Bitcoin account that's also easily interfaceable through a bank, right?
Yeah. And on that front, where there is a problem. I mean, it's fact. It's pretty ingrained. Is if you have an account and you're only saving in dollars, you're not, like, that's true. You're not doing yourself any favor. So you have to have some asset that stores value, and that's really what's broken more so than currency and spending. And Bitcoin has done that job very well.
I agree. Well, Kane, maybe we can wrap it up here. I appreciate the time. It was good to catch up with you. It's been a while. I think the last time we caught up was in person in Nashville, so over 6 months ago. What if anyone was interested in the conversation and just wants to get in touch, whether just to chat about Bitcoin or learn more about the wealth management business, how should they reach out to you?
Yeah. Well, first off, thanks for having me on. Shameless plug on your end. They can look at this podcast on Onramp's website and social media. But no, I'm on Twitter. I do everything under my name. I just kind of think if you're going to say something, say it, and let your name be by it. So it's just my name, or I guess X. I always say Twitter. Substack. I write stuff. So DMs are open, and happy to chat. I think Bitcoin is super important for the future. I think it's important for the monetary system. I think that we're seeing that happen. It does appear that powers that be understand that, and I think that's a good thing for the United States. I think that was our best shot at getting off the path we were on. So I think all those things are important, and I appreciate the conversation today.
Thanks, Kane. As do I.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.